Listen carefully, because in markets, the most dangerous moments are the quiet ones. There are days when nothing appears to happen. Prices move within expected ranges. Analysts repeat familiar phrases. Commentators reassure. Liquidity flows as it always has. And yet beneath the surface, something fundamental shifts. Not violently, not visibly, but decisively. This story begins on one of those days. No flashing headlines, no emergency press conference, no official acknowledgement. Just a document, circulated internally, written in measured language, stamped with urgency not in tone but in timing. A memo that does not shout. It does not threaten. It instructs, and in finance, instructions are rarely philosophical. They are operational. The subject was silver, not as a metal, not as a commodity, but as a risk. Inside Morgan Stanley, one of the most influential financial institutions in the modern global system, a decision was being framed not as speculation, not as opinion, but as necessity. Exposure to silver in multiple forms was being reassessed, not for upside, not for opportunity, but for containment. The memo did not describe panic, but panic rarely announces itself. It shows up as coordination, as immediacy, as an abrupt change in posture by institutions that pride themselves on foresight and control. Silver, for decades, has occupied a strange position in global finance, too small to dominate headlines like oil, too industrial to be romanticized like gold, too volatile to be trusted, and yet too essential to ignore. It sits at the intersection of two worlds, one monetary, one industrial, and that intersection is precisely where pressure accumulates. The official narrative has always been simple. Silver is an industrial input. Solar panels, electronics, medical applications, a commodity governed by supply and demand, innovation and substitution. But that narrative has never fully explained why silver trades the way it does. Why paper contracts so vastly outnumber physical supply. Why price suppression accusations never fully disappear. Why inventories fluctuate in ways that defy ordinary consumption models. And most importantly, why institutions treat silver not as an asset, but as a variable that must be controlled. Morgan Stanley understands this better than most. This is not a retail bank. This is not a speculative fund. This is an institution embedded in the architecture of global capital. It does not react to rumors. It reacts to imbalances. And the imbalance, according to the Memo, was no longer theoretical. The document outlined a sequence of developments. Rising physical demand outside Western markets. Inventory drawdowns across major exchanges. Increasing delivery pressure on paper contracts. A widening divergence between futures, pricing, and physical premiums. None of this was new in isolation. What was new was convergence. For years, the system has relied on fragmentation. Physical here. Paper there. Retail interest over there. Industrial consumption somewhere else. Central banks pretending not to notice. But when fragmentation collapses, when signals align, when independent pressures begin reinforcing one another instead of canceling out, that is when institutions move. The memo referenced risk concentration. Not just exposure on balance sheets, but exposure in credibility. Silver markets function on confidence. Confidence that contracts will roll. Confidence that delivery will remain optional. Confidence that price discovery will remain orderly. Lose that confidence, and the market does not gradually adjust. It snaps. Morgan Stanley did not want to be holding silver when, or if that snap occurred, so the instruction was clear. Reduce exposure. Accelerate liquidation. Prioritize immediacy over optimization. In other words, get out. To understand why, you have to step back, not days or weeks, but decades. The modern financial system is built on abstraction. Claims layered on claims. Instruments referencing instruments. Value defined not by possession, but by enforceability. Silver inconveniently resists abstraction. You can short it. You can lease it. You can rehypothecate it. But eventually, someone asks for the metal. And when that happens, the system is forced to reconcile paper with reality. For most assets, reconciliation is easy. Cash settles. Bonds roll. Equities clear. For silver, reconciliation is physical. A bar either exists or it doesn't. Over the last several years, global dynamics have shifted in ways that make that distinction dangerous. Western economies, burdened by debt, have relied increasingly on financial engineering, low rates, quantitative easing, asset inflation, confidence management. At the same time, non-Western economies have been accumulating physical resources, energy, metals, infrastructure. Silver has quietly migrated east. India, China, Southeast Asia. Industrial hubs where demand is not speculative but functional. And unlike Western investors, these buyers do not view silver as a trade. They view it as a strategic input. When strategic buyers acquire physical supply, it does not come back. The memo noted this trend without commentary, No ideology, no accusation, just math. Available supply was tightening. At the same time, derivative exposure remained enormous. This is where the danger lies. The silver market, like many commodities, is dominated by futures. Contracts promise delivery at a later date, often rolled forward indefinitely. Most participants never intend to take delivery. The system depends on that assumption. But assumptions fail under stress. When enough participants decide they want the metal, not the cash equivalent, the system has to choose. Either source the silver or settle in cash and risk breaking the illusion. Breaking the illusion is not a small event. It signals that price is no longer discovered, it is imposed. And imposed prices invite challenge. Morgan Stanley's memo framed silver not as an opportunity, but as a trigger for reputational risk, for liquidity strain, for regulatory scrutiny. It referenced historical precedents. The Hunt brothers in the 1980s, the rapid rule changes, the emergency interventions. But this time, the scale is different. The global economy is more leveraged. Supply chains are more fragile. Trust in institutions is thinner. And silver is embedded in the technologies that are supposed to define the future. Green energy, electrification, defense systems, medical infrastructure. This is not a market that can simply be paused. If silver prices spike uncontrollably, the consequences ripple outward. Production costs rise, government projects overrun. Inflation accelerates. And inflation, once unleashed, does not respect narratives. Governments respond to inflation with policy, rate hikes, liquidity withdrawal, public messaging, but those responses have costs. Higher rates strain debt. Tighter liquidity exposes weak balance sheets. Messaging loses power when lived reality contradicts it. The memo did not accuse governments. It did not speculate on intent. It simply acknowledged constraints. Policymakers are boxed in. They need growth. They need stability. They need controlled inflation. Silver threatens all three if it escapes containment. So institutions act preemptively. They do not wait for confirmation. They do not wait for headlines. They move when probability crosses a threshold. Morgan Stanley's decision to liquidate was not about silver itself. It was about what silver reveals. It reveals stress in the paper system. It reveals the limits of control. It reveals the divergence between financial representations and physical reality. And most dangerously, it reveals how quickly confidence can evaporate when abstractions are challenged. The memo emphasized timing. Not next quarter. Not over the next year. Immediate. That word appears rarely in institutional communication. It implies urgency without panic. It implies that delay increases risk nonlinearly. Immediate liquidation means accepting less favorable pricing to avoid uncertain outcomes. It means sacrificing profit for certainty. Institutions do not do this lightly. They do it when optionality disappears. And optionality was disappearing. Behind the scenes, clearinghouses were adjusting margin requirements. Exchanges were monitoring delivery requests. Premiums in physical markets were detaching from spot prices. Retail investors noticed something was wrong, not because prices were rising, but because availability was shrinking. Coin shops reported delays. Mints rationed output. Industrial buyers locked in long-term contracts. These are not speculative behaviors. They are defensive. The memo understood this distinction. Speculation chases price. Defense chases supply, and when defense becomes widespread, price becomes secondary. The silver market was entering that phase. Morgan Stanley did not want to be exposed to a market where price signals lose meaning, where settlement risk becomes real, where regulators step in not to stabilize markets, but to preserve confidence. Confidence preservation often involves rewriting rules, position limits, cash settlement mandates, trading halts. These actions protect the system, but they punish participants caught on the wrong side. The memo implicitly acknowledged this. Better to exit now than negotiate later. Better to liquidate quietly than explain publicly. Better to accept criticism for conservatism than scrutiny for instability. This is how institutions think, not in moral terms, in survivability. And survivability, in this context, meant distancing from silver. As word of the memo leaked, first as rumor, then as pattern, other institutions took notice. Not because they trusted the source, but because they recognized the behavior. When a major player D risks a specific asset class rapidly, it is rarely idiosyncratic, it is usually informational. Markets are social systems. They respond not just to data, but to observation of others' actions. The leak itself became a signal, and signals once emitted cannot be recalled. Silver prices did not explode. That would have drawn attention. Instead, volatility increased subtly. Liquidity thinned. Spreads widened. The market was becoming brittle. Brittle markets do not collapse suddenly. They fracture under pressure. And pressure was building? Governments continued to speak confidently about energy transitions, technological expansion, sustainable growth, but those plans depend on materials. And materials depend on extraction, processing, and trade, systems increasingly strained by geopolitics. Trade routes are less secure. Alliances are less stable. Sanctions distort flows. Silver sits uncomfortably within these tensions. It is not strategic enough to be openly weaponized, but it is too important to ignore. That makes it vulnerable. The memo did not predict collapse. It did not forecast price targets. It did not dramatize. It simply removed exposure. And that, in financial terms, is the loudest statement possible. Because institutions that believe in stability increase exposure during uncertainty. They provide liquidity. They arbitrage fear. Institutions that fear instability withdraw. Morgan Stanley withdrew, not from markets broadly, not from risk generally, from silver. And when an institution of that stature makes a selective exit, it raises a question that no memo can answer. What do they see that others don't? Or more unsettlingly, what do they see that others refuse to acknowledge? Because silver is not just a metal, it is a mirror. It reflects the tension between promise and possession, between claims and reality, between control and consequence. And when that mirror cracks, it does not shatter quietly. It fractures confidence. As part one closes, nothing has broken yet. Prices still print. Contracts still trade. Official statements remain calm. But beneath it all, a line has been crossed. A major institution has decided that silver no longer belongs on its balance sheet, not because silver is weak, but because the system around it may be. And once that possibility enters the institutional mind, it does not leave easily. It waits. Just like pressure beneath the surface. Unseen, unresolved, and increasingly difficult to contain. What happens next does not unfold on trading screens alone. It unfolds in behavior. Markets reveal stress not through collapse, but through coordination failures. Through subtle shifts in how participants act when they believe no one is watching. Through the quiet recalibration of risk that precedes any visible event. After the memo, nothing dramatic occurred. And that was precisely the point. Institutions do not announce exits. They disguise them as routine adjustments. They spread activity across desks, across days, across jurisdictions. The goal is not speed, it is invisibility. But invisibility has limits. Because silver is not a market you can leave without consequence. Liquidity in silver is thinner than it appears, much thinner. A large portion of daily volume exists on paper, not in metal. When a major player begins unwinding positions tied, directly or indirectly, to physical delivery, the strain propagates outward. First, through counterparties. Clearing members notice settlement behavior changing. Rollovers that once occurred automatically now require negotiation. Margin calls become more frequent, not because prices are moving violently, but because risk models are being quietly adjusted. These models are sensitive to one thing above all else: confidence in settlement. When that confidence erodes, even slightly, leverage becomes dangerous. And leverage is everywhere. Silver futures are leverage instruments by design. Industrial hedgers use them to lock in costs. Financial players use them to express views with minimal capital. The system works as long as volatility remains within expected bounds and delivery remains hypothetical. But once delivery becomes plausible, once enough participants consider standing for metal, the system's assumptions no longer hold. After the memo, internal risk committees at other banks began asking uncomfortable questions. Not publicly, not formally. Questions like, what percentage of our silver exposure could realistically be delivered if demanded? How concentrated are our counterparties? What happens if exchange rules change mid-cycle? What happens if cash settlement is enforced at a price the market no longer recognizes as legitimate? These are not academic questions. They are existential. Because the modern commodity market is built not to deliver metals, but to manage expectations. And expectations are fragile. The second phase of stress did not show up as a price spike. It showed up as hesitation. Dealers widened spreads. Market makers reduced size. Bid-ask dynamics became asymmetric. Buyers had to work harder, sellers less so. That is not normal behavior in a balanced market. It signals uncertainty about inventory. Physical premiums, long dismissed as irrelevant to real price discovery, began to diverge more noticeably from futures prices. This divergence is often ignored by institutional models, which assume convergence over time. But convergence only occurs when arbitrage is possible, and arbitrage requires metal. When metal is scarce, arbitrage becomes theoretical. The memo had noted this risk explicitly. Physical supply was not disappearing overnight. It was being absorbed quietly by buyers who do not recycle inventory back into the market. This matters because silver supply is not elastic. Unlike fiat currency, it cannot be created at will. Unlike many commodities, it is rarely mined for its own sake. It is mostly a byproduct of copper, lead, zinc. That means supply responds slowly to price signals. Even a sharp price increase does not immediately produce more silver, and yet demand was becoming less price sensitive. Industrial users do not stop buying silver because it becomes expensive. They stop when they cannot get it. That distinction is crucial. The third phase unfolded at the policy level, not through action, but through silence. Central banks rarely comment on silver. It is not officially monetary, despite its history. It is not large enough to threaten currencies directly, but central banks watch it closely. Because silver reacts early to monetary stress. It is more volatile than gold, more sensitive to liquidity conditions, more exposed to industrial cycles. When silver behaves strangely, it often precedes broader dislocations. After the Memo, silver began exhibiting behavior that did not align neatly with macro narratives. Rates were rising. Liquidity was tightening. Risk assets were under pressure. Silver should have weakened, it did not. It drifted. It resisted. It refused to break decisively. This kind of price action frustrates models. It suggests hidden demand. Hidden demand is the most dangerous kind because it cannot be deterred by rhetoric. Governments, facing inflationary pressure, continued to emphasize stability. They highlighted moderation in headline numbers. They stressed the effectiveness of policy tools. But these tools have limits. Interest rates can cool demand. They can slow borrowing. They can reduce speculation. They cannot create metal, nor can they force sellers to sell. As geopolitical tensions intensified, trade restrictions, sanctions, strategic stockpiling, the assumption that global markets would remain frictionless grew less credible. Silver, caught between industrial necessity and financial abstraction, absorbed that tension. Meanwhile, exchanges began adjusting rules, not overtly, but incrementally. Position limits were reviewed. Delivery procedures clarified. Margin requirements nudged upward. These changes were framed as prudent risk management, and they were, but they also signaled concern. Exchanges exist to facilitate trade. When they shift focus toward containment, it reflects systemic unease. The Memo's logic was spreading, not as panic, but as alignment. Alignment among institutions that understand one fundamental truth. When too many claims exist on too little reality, the system must eventually choose which claims matter. That choice is rarely fair. It is usually political. Who gets metal? Who gets cash? Who absorbs losses? Who receives protection? These decisions are not made by markets alone. They involve regulators, and regulators in turn respond to governments. Governments respond to voters, debt markets, and geopolitical constraints. Silver sits at the crossroads of all three. It influences industrial output. It affects inflation. It exposes the credibility of financial infrastructure. That makes it inconvenient. And inconvenient assets are often managed, not allowed to express themselves freely. The Memo implicitly acknowledged this. By exiting early, Morgan Stanley avoided being entangled in any future management of the silver market, because management often comes with strings attached, forced settlements, regulatory inquiries, political scrutiny. No institution wants to explain why it held a position that destabilized a strategic input market during a fragile economic period. Better to be absent. As the weeks passed, whispers grew louder, not about a single memo, but about a pattern. Large banks reducing precious metals exposure selectively, not exiting entirely, but reshaping portfolios away from assets tied to physical constraints. Gold remained, to an extent, manageable. Central banks hold it. It is politically acknowledged. Silver is different. It lacks official status, but carries real-world consequences. That makes it harder to defend. At the same time, retail interest began rising, not explosively, but persistently. Retail investors are often dismissed, and often rightly so. But retail behavior can reveal something institutions overlook, sentiment unfiltered by models. People were not buying silver because of price charts. They were buying because they distrusted narratives. They saw supply issues. They experienced inflation. They noticed contradictions. Silver, tangible and finite, appealed to that psychology. This did not go unnoticed. Large institutions track retail flows carefully, not because retail capital moves markets, but because retail belief can force institutional response. When belief aligns with scarcity, pressure builds. The system can tolerate disbelief. It can tolerate speculation. It struggles with conviction. By the time the second phase matured, the silver market had changed character. It was no longer just a trade. It was becoming a statement about trust and settlement, about faith in abstraction, about confidence in institutions' ability to manage complexity without breaking credibility. The memo had been an early acknowledgement of this shift. Not a cause, but a recognition. Recognition that the silver market was no longer behaving like a controlled environment. Recognition that interventions, if needed, would carry reputational costs. Recognition that staying involved offered limited upside and asymmetric downside. Morgan Stanley's worldview, rooted in risk management, systemic awareness, and survival, had dictated exit. Others would follow, quietly. Not because they agreed ideologically, but because they shared the same incentives. As exposure declined among large players, something paradoxical occurred. Volatility compressed. This seems counterintuitive. One would expect instability, but reduced participation by large institutions can create artificial calm until stress exceeds a threshold. This calm is dangerous. It lulls observers into complacency. Prices drift sideways. Headlines fade. Attention moves elsewhere. But beneath the surface, depth disappears. When the next shock arrives, be it geopolitical, industrial, or monetary, the market's ability to absorb it will be diminished, and that is when fractures become visible. The second phase ends not with a crash, but with an absence of liquidity, an absence of conviction among institutions, an absence of clarity about who ultimately controls the market. Silver continues to trade, but it no longer trades like a neutral commodity. It trades like a question about whether the financial system can continue to balance infinite claims against finite resources. A question about whether trust can be maintained through coordination alone. A question about what happens when too many participants decide that possession matters more than promise. By the end of Part 2, nothing has failed. No exchange has defaulted. No delivery crisis has been declared. And yet, the system feels thinner, less resilient, more conditional. The fracture is not a break. It is a widening gap between what markets say and what they can deliver, and gaps, once noticed, tend to grow quietly, relentlessly, until something forces them into the open. The final stage does not announce itself as a crisis. It arrives as normalization. This is the part most people misunderstand. They expect rupture to look dramatic, prices screaming higher, headlines panicking, institutions scrambling in public view. But modern financial systems are designed to prevent spectacle. Not because they eliminate risk, but because they manage perception. What unfolds instead is quieter, more procedural, more unsettling. By the time the silver market reaches this phase, the question is no longer whether something is wrong. That has already been answered. The question becomes who will absorb the consequences and how discreetly it can be done. After the memo, after the quiet exits, after the subtle rule changes and behavioral shifts, the market enters a holding pattern. This is not stability. It is containment. Contained systems appear calm precisely because pressure is being redistributed elsewhere. Look closely at where that pressure goes. It moves into opacity. Reporting becomes less granular. Inventory data is delayed, reclassified, or aggregated. Terms like eligible and registered become more prominent, more ambiguous. The language of transparency is preserved, but its substance thins. This is not deception in the crude sense. It is risk management through abstraction. If clarity invites panic, ambiguity buys time. Institutions understand this instinctively. Governments understand it as well. Silver, at this point, becomes politically inconvenient. Not important enough to headline policy debates. Not large enough to justify overt intervention. But too sensitive to allow free expression. So the system resolves the tension the only way it knows how. It narrows the channels. Fewer participants. More centralized control. Greater emphasis on cash settlement. Less tolerance for physical strain. None of this requires an announcement. It happens through incentives. Exchanges adjust fees. Clearinghouses raise capital requirements. Banks revise internal models in ways that make certain positions unattractive without explicitly banning them. Risk managers begin using a new phrase, non-core exposure. Silver quietly becomes non-core. This designation matters. Non-core assets receive less balance sheet allocation. Less market-making support, less advocacy during stress. They are allowed to exist, but not to disrupt. At the same time, industrial users are encouraged, informally, to secure supply through long-term contracts rather than spot markets. This removes pressure from visible price mechanisms and relocates it into private agreements. Price discovery weakens, not because demand disappears, but because demand is being routed away from the public eye. This is how systems survive without reform. They do not fix contradictions. They bury them. For a while it works. Silver prices remain volatile but bounded. Headlines shift focus. Commentators declare the episode overblown. And yet, something irreversible has happened. Trust has been tiered. Large institutions no longer treat the silver market as a neutral arena. They treat it as a managed risk zone. Retail participants sense this intuitively. They experience it as frustration, difficulty sourcing metal, unexplained premiums, delays. But frustration alone does not break systems. Disillusionment does. As time passes, a subtle bifurcation emerges. There is the silver market as quoted, and the silver market as lived. The quoted market exists on screens, futures prices, options curves, analytical commentary. The lived market exists in supply chains, in procurement offices, in mints, in vaults. The distance between these two grows. This distance is not unique to silver. It exists in other areas of the economy as well: housing, energy, labor. But silver is unusual in that it exposes the distance so cleanly, because it cannot be digitized away. Eventually, someone notices. Not a retail investor, not a pundit, a policymaker. Not because silver itself threatens policy goals, but because its behavior contradicts official narratives. If inflation is under control, why are industrial input costs rising unpredictably? If markets are liquid, why are suppliers insisting on prepayment and long-term commitments? If financial infrastructure is robust, why are settlement assurances becoming conditional? These questions are not asked publicly. They are asked in closed rooms, in cautious language, with an eye toward consequences. The answer, when it comes, is unsatisfying, because the problem is not a single policy failure. It is structural. The global economy has grown accustomed to decoupling price from constraint, to treating resources as financial variables rather than physical realities. Silver resists that treatment. It keeps reminding the system that there are limits. Limits to leverage, limits to abstraction, limits to coordination. At this stage, the system faces a choice. Allow silver to reprice in a way that reflects physical scarcity and industrial importance, or suppress volatility and accept inefficiencies elsewhere. Repricing would be disruptive. It would raise costs, expose leverage, undermine confidence in existing contracts. Suppression would be quieter. It would distort signals, encourage hoarding, reduce trust in official mechanisms. Neither option is attractive, so the system chooses neither. It chooses delay. Delay through regulation, delay through messaging, delay through complexity. This is not a conspiracy. It is institutional inertia. Large systems do not pivot easily. They absorb shocks by distributing them across time and space. The cost of this approach is not immediate collapse. It is gradual erosion. Erosion of belief that markets are fair. Erosion of confidence that prices mean what they say. Erosion of trust that institutions prioritize transparency over convenience. Silver becomes a symbol of this erosion, not because it causes it, but because it reveals it. By now, Morgan Stanley's Memo feels distant. A footnote. An early move, but its significance has grown in retrospect. It marked the moment when a major institution decided that participation itself was riskier than absence. That decision did not fix the system. It simply reduced exposure to its weakest point. Others did the same, and when enough participants act defensively, the system's apparent stability becomes a function of exclusion rather than resilience. Who remains in the silver market now? Smaller players, industrial hedgers with no choice, retail holders operating outside institutional frameworks. This changes the character of the market. Less depth, less buffering capacity, more sensitivity to shocks. The system has traded robustness for control. Control is appealing to policymakers. Robustness is appealing to participants. These priorities are not always aligned. As global conditions continue to evolve, energy transitions, geopolitical fragmentation, fiscal strain, the demand for silver does not diminish. If anything, it becomes more essential. And essential resources have a way of asserting themselves eventually, not explosively. But persistently, the unresolved weight of this story is not that silver will moon or that markets will collapse overnight. Those narratives are distractions. The weight lies in what the response to silver reveals about the broader system. A system that increasingly prefers management to truth, that treats symptoms while leaving causes untouched, that relies on confidence even as it undermines the foundations of that confidence. At some point, no one can say when the distance between quoted reality and lived reality becomes politically untenable. When that happens, adjustments occur. Sometimes abruptly, sometimes unfairly, often at the expense of those least able to adapt. Silver will not be the headline when that moment arrives. It rarely is. But it will have been there all along, reflecting the strain, absorbing the pressure, signaling imbalance to anyone willing to look beyond price charts. The leaked memo was not a prophecy, it was a precaution, a quiet acknowledgement that the rules are less stable than they appear, that the architecture of trust is more fragile than advertised, and that in a world built on promises, anything that demands delivery becomes dangerous. As this documentary closes, nothing is resolved. Markets continue. Institutions function, policies are adjusted. But the question lingers, not spoken aloud, not priced in fully. If a system requires constant containment to remain stable, what happens when containment itself becomes the risk? That question does not demand an answer today. It waits, like silver in a vault, like pressure beneath the surface, like trust, once questioned, never fully restored.